The Reserve Bank's Monetary Policy Committee has decided to increase rates by 75 basis points. That's the highest rate hike in years. This takes the repurchase rate to 5.5% and the bank's prime lending rate to 9%. Now, the bank has raised the repurchase rate for the fifth successive time since November last year. Reserve Bank Governor Lesetja Kganyago says the upside risk to the inflation outlook on the back of rising fuel and food prices is one of the main reasons behind the bank's latest decision. Economist and director at Pax Africana Holdings, Ndumiso Hadebe, joins us now virtually. A very good morning to you, Ndumiso. Thank you so much for joining us. Welcome to Morning Live.
Good morning, Simpiwe, and a very good morning to the viewers of Morning Live.
Well, it's an absolute pleasure because it's a very, very important discussion that we're having. I mean, was this perhaps the Reserve Bank trying to stamp its authority and showing the world that it's got inflation in check here in South Africa?
I think it's been the track record of the Reserve Bank to do all within its power to ensure that there's a price stability within the South African context and, of course, protecting the strength of the South African rand. Because as we've seen in other parts of the world with some of the social unrests that have been associated with the accelerated pace of price increases emanated by and driven by the rising cost of fuel. Even when we look at the inflation data that came out in South Africa this week, we've seen that the single biggest contributor have been transportation costs, which have been linked to the rising oil prices, which in 2022, something that we didn't expect happen, where we hit the over $100 a barrel mark, which has then affected a lot of the emerging and also developed markets in terms of an inflation point of view. And so this has been a particular response by the Reserve Bank to respond to that. Although in the South African socio-economic context, it certainly does have specific ramifications in this instance, because there are two main issues that are certainly at hand here. The first being looking what is the cause of rising inflation in the South African context, and of course, what is then the policy setting that will enable meaningful responses given the socio-economic context of the South African context. The first being, Simpiwe, is that we're dealing with the question of whether or not is this a demand pull inflation context or is it a cost push inflation context. In the South African context, we're seeing that a lot of this is associated with a cost push inflation context, which is again what the Reserve Bank governor highlighted around the rising cost of fuel and of course of rising food prices as well. The question then becomes, what is then the policy setting that ought to be responsive in respect of this increased driving of prices in our context? The first being is the Reserve Bank has indeed responded with a hiking of 75 basis points, although I certainly anticipated a 50 basis points hike. But I think given the higher than expected inflation numbers that have come out, that is what has necessitated that. The second being, what are some of the responses that are necessary from a fiscal policy point of view and supply side point of view? From a fiscal point of view, we saw some of the interventions that came out from the government and National Treasury, the pronouncements that they made in halting some of the administered taxes in relation to the cost of fuel. Now, that did certainly have some level of relief, but it certainly is not enough. Then there are other targeted interventions that I think are necessary in relation to some of the supply side issues where specific industries are affected by the increasing cost push inflation scenarios, which is the price of fuel, such as farmers in this instance, manufacturers, which then feeds into specifically some of the goods and services that you and I consume, and ultimately then resulting in this kind of monetary policy response.
You know, Ndumiso, I would imagine it has been a tough balancing act for the Reserve Bank. You know, on the one hand, trying to juxtapose reining in the runaway inflation, and then on the other hand, trying to cushion consumers against the adverse effects of inflation. So what would you suggest the Reserve Bank would have done to ensure that consumers are prioritized in this particular instance?
I think the Reserve Bank in this instance, given its particular role, it's doing within it's within its mandate to be able to ensure that there's price stability and the preservation of the South African currency. What I do think we should be viewing this through the lens of a basket of interventions that would certainly relieve consumers particularly given the socio-economic context of the South African consumer landscape. And again, by answering that question to say, what are some of these baskets of policy interventions that need to be put in place to certainly protect consumers? It certainly has to be looked at targeted interventions at the level of both monetary policy, which we've already seen responses from. We've seen some highlighted responses from a fiscal policy point of view, which I think would need to then be sustained, particularly when we look at what is the economic cost of having these interventions in place to the South African economy versus not having those interventions in place. So that's a question that government would need to answer quite amply. And of course, targeted responses from a supply side point of view, which then relieve the overall consumer basket of goods in terms of ensuring that consumers are shielded from the accelerated inflation in this instance. But of course, there are other interventions which are more long-term around what does it look like to ensure that the accelerated pace of the reindustrialization of the South African economy looks like, particularly in sectors that have high employment multipliers? Because when you have an inflation uptick, such as we're having in the year 2022, and you have wages that are not rising at the same pace at which inflation is, you're then bound to see some labor issues then arising as a consequence of that. And so it's important then to ensure that the overall targeted industrialization plans are indeed effected on time and within budget, and to ensure that the multiplier effects associated with that are then realized within the forecasted period. I think those basket of interventions then are able to aid consumers in being protected, because it also speaks to the increase in wages that would also somewhat offset the cost of the rising inflation that we're also seeing in the year 2022.
And speaking of basket of interventions, I mean, this brings more suffering for households as it leads to home and vehicle repayments going up. So what can individuals and households do to deal with the runaway costs to alleviate this burden?
Well, from a lending point of view, there are some considerations, of course, depending on what the household income situation looks like. But of course, for consumers who certainly have secured lending products from financial institutions, there could be considerations around what is the cost of having a fixed interest rate versus the variable interest rates which they might have presently, and what would be the opportunity cost from a medium to long-term point of view, from a repayments point of view, because from a secured lending point of view, that particular option is indeed available. However, from an unsecured lending point of view, it then becomes that difficult situation where certainly you have a linked inflation rate. And of course, you need to then look at how can you be able to explore in ensuring that you optimize the limited resources as a household that you have. And of course, I'll certainly refer to some of the consumer trends that some of our parents used growing up, such as bulk buying and basically leveraging some of the associated uses of goods and services in a circular economy, such as the reuse of certain products in certain instances in innovative ways, so as to sustain the use of those products, so that households don't spend consistently on the same thing unnecessarily. So it certainly does require some level of creativity in order to ensure that consumers are able to offset the uptick in inflation in this instance. Additionally, I think it also requires additional innovation and creativity around what other revenue streams could be explored in this particular environment, because there are other opportunities that can certainly be explored in such a setting as well.
Yeah, and the Reserve Bank Governor Lesetja Kganyago saying that they heard the cries of the South Africans as salaries are eroding, and the Reserve Bank is doing whatever it can to deal with the situation. So does the government then have any other options that can be used as instruments to counter inflation?
Most certainly. I think there are a number of interventions, and particularly, Simpiwe, if we are to look at it from the context of what is the economic cost of having an uptick in inflation and only having monetary policy responses as a solution to this particular intervention, and then clearly we would then see that the biggest single risk or threat to any type of investment, be it from an individual investor point of view, which is you and I, or from an institutional investor point of view, is indeed the threat of inflation and the threat of price instability and the weakening of the South African rand. Because regardless of how hard you can be able to work and generate revenue, but if the value for your rand is being eroded, then it diminishes the value of the work that has been put in there. And so the interventions that would need to be put in place are quite similar. And it certainly does require a proactive approach on the side of government to explore what are some of these targeted interventions that can be able to provide this kind of relief from this inflation environment that we're particularly facing. So case in point would be to look at what are some of the packages that are most meaningful, particularly for the most poor in South Africa, in the basket of goods they're consuming, and seeing from a supply side point of view, who are the providers and producers of those particular basket of goods, and having specific subsidies that would relieve them from increasing their prices. Because from a producer point of view, when you're hearing this kinds of inflationary news and interest rates hikes, you start pricing in the cost of that within your products. So government can intervene directly in looking which industries are specifically targeted from this cost push inflation environment, and how can we provide subsidies and relief that would ensure that consumers ultimately are also protected and shielded, particularly the most vulnerable and poor in the South African economy. And those are some of the programs and basket of interventions or rescue packages, as it were, as we've seen in the COVID environment, that can provide some relief in the South African context.
Well, my understanding of what you just said is that the government should start borrowing from Peter to pay Paul. And, in short, tapping into other reserves to try to cushion the consumers against inflation in other sectors. This takes place a day after the announcement that the inflation rate went up to 7.4%. And there's also suggestions, of course, that, that the government should consider a tax relief at a time like this. Would that be an effective remedy?
Well, in this instance, I think there are fiscal reserves that have been allocated, which we have seen some of them being allocated towards what has transpired in the KwaZulu floods that we've seen recently. Mm-hmm. And some of those reserves can then be aided to be able to leverage these targeted interventions or basket of interventions to relieve not only producers, but ultimately have the subsequent effect of relieving consumers in this instance. Questions around tax relief and so on. Some of those tax relief, that it then boils down to what some of the modeling would look like, because we then have to look at what the tax relief would mean for particularly the most vulnerable in this particular setting, when you also adjust it for inflation and other costs that would also speak to what kind of impact that tax relief would look like. Additionally, ultimately, what would then mean for the forecasted revenues from the South African government, and ultimately how that would permeate and speak to the forecasted budget allocations in the coming fiscal years, and whether or not it's still in track or on track with the MTEF fiscal framework in this instance. So that ultimately are considerations that would need to be looked at and see what are some of the scenario planning outcomes and impacts would look like in that instance, if that would be an option. But I think what would be most meaningful is certainly exploring these targeted basket of interventions, particularly where we are seeing the cause of a rising inflation in the South African context, as that would be the most meaningful, particularly with goods and services that adversely affect the poor. We've also seen the taxi industry also rising or increasing the costs of taxi fare in this instance, which of course we would know that some of the most vulnerable in South African economy, approximately 60% of their income has been associated with the costs of transportation going to and from work. That's a targeted intervention that can also be explored in such an instance to be able to relieve consumers in this instance, because inflation, as the old saying goes, inflation eats you, you don't eat inflation in this instance. Yeah.
Are you also of the view that a review of the fuel price structure and an audit of the components that comprise the fuel structure should also be considered?
I think that's an area of exploration, because particularly if we were to look at what are some of the efficiency gains from a tax administration point of view, and are there other efficiencies that can be explored within the South African socioeconomic landscape that would be optimal in relation to the present structure. So I'm certainly for an evaluation and assessment and the feasibility of what the current structure looks like, and what are some of the other efficiencies that can be leveraged from a tax administration point of view, particularly given the socioeconomic situation situation in the South African context with the rising unemployment and so on. But again, I think that it is in the short term, Simpiwe. In the long term, we need to look at what is South Africa's plan or economic policy plan in relation to industrialization, in relation to the absorption of young people in the South African economy, so that they're also able to participate more meaningfully in respect of the wages that they will be earning, and of course the levels of rising innovation that are required to solve for some of these problems that would reduce some of the costs and improve efficiencies in the South African economy. In the long term, ultimately, that is what makes South African, or what makes economies grow sustainably. Some of these structures are certainly short-term considerations, given the pressures that are driving the economy or the global economy even at large. And so ultimately, we also need to have a lens that says, what is the positioning of the South African economy given the current context and where the global economy is headed, and what are some of the critical investments that we need to make, given some of the advantages that we enjoy, particularly from a demographics point of view, from an intellectual property point of view, infrastructure point of view, and some of the advances that we need to make where governance is concerned as well.
Yeah, and speaking of advances that we need to make, I mean, what about the national debt, as lenders generally are faced with steep loan repayments due to rising interest rates? I mean, what does this do to the fiscus and local development as growth keeps shrinking?
In the context where you see growth shrinking, you're then seeing a smaller tax pool of individuals who are then able to contribute to the revenues, to the National Revenue Fund in this instance. But secondly, we're also seeing constraints. Whenever there is a lack of economic growth, we're also seeing that a lack of participation and a despondency in terms of folks who are of working age, who see opportunities to be able to participate in the South African economy also increasing as a result. And that creates an overall landscape where in recent times there have been talks around stagflation, which has been a situation where we're seeing rising inflation, and of course we are seeing economic growth that is not impressive at all. And so you're seeing such themes also coming out quite strongly. And so it requires what in certain instances may then refer to a sum of counter-cyclical approaches to be able to resolve some of these issues. When it comes to the question of national debt, that is fundamentally not only a question of looking at what are some of the consumer behaviors and trends from a lending point of view, but what is the savings rate in the South African context? Because if we were to talk about investment, investment is a function of savings, and those savings then need to have been generated through a process of value creation. That value creation being where you've seen consumers or institutions being meaningfully active economically in this context. And when we look at what are the drivers of economic participation, it's a function of value creation. But if we don't have targeted interventions from an industrialization point of view, from a supply side policy point of view, from supporting it from a fiscal policy framework point of view, and ensuring that the governance frameworks in place ensure that those things that we have planned work according to the associated plan, then it creates those limitations. And then we're seeing the signals of national debt being a trigger for some risks for both institutions and for households in this instance. So ultimately, it's a function of what is the economic plan that can be able to drive this, and do we have the requisite governance measures that will enable that we achieve the targets that we've set.
And more so because the central bank is now concerned about, the rising imported inflation as a result of, increasing global price pressures and the war in Ukraine, perhaps. And, the market expectation of only a narrow breach of the inflation target will be reset. And this has thrown into question the Reserve Bank's, anti-inflation credentials. And Ndumiso, great chatting to you. Thank you so much for joining us.